Hey everybody. No Hadley today, so me and DJ tag team in this one. Gonna touch on a couple of things market and rate related, and then get into a couple of extra topics. So let me see if I can share my screen first here. Don't know that I have the ability to do that.
She's going to give you capability. She may not have. There she is.
Hi, it looks like you do have it.
Oh, there it is. Okay. Thank you.
You're welcome.
All right, everybody see this?
Yep.
This is CPI. So was that today?
It was today.
Today.
This morning.
The CPI report came out. That's the Consumer Price Index. Pretty big inflation indicator. Anytime I pull up this report, obviously there's a lot of jargon, a lot of numbers in here, hard to digest, but I feel like this chart in the middle of the screen here says pretty much everything you need to see. If that red and blue line continue to tread down, things are improving, or at least inflation's improving. And you can see over the last 12 months, we're continuing to trend down. A little jump there back in the winter and spring, but back on course. The Fed has long said that their target is between 2 and 3%, and we're there now. So I'm sure you've already seen the headlines. Sounds like the Fed is most likely lowering rates, which is kind of my next thing I wanted to jump into here. This is the likelihood.
Just to jump back real quick to that, Chris, the reason CPI, I think you would have had a huge market rally today in the bond market had shelter costs, which are rents, and insurance costs not stayed elevated. All reports were pointing to the fact that both of those numbers were supposed to come down, and neither of them did. And that's what kept the CPI at the level it's at. Otherwise, I think you would have had a huge rally in the bond market and the stock market. With that said, the stock market's going the other way. I think it's down somewhere between now it's only down through 200 points. It was down about 400 to 500 points earlier, but bond market's pretty flat today.
Yeah. I always think it's interesting when you see food and energy stay steady, but all other items. So when you see the blue line take a big tumble, but you see the red line stay steady, it's interesting. So ideally, you see both of those trending down. I would say, relatively speaking, though, we're still in a much, much better place than we were. If you were to extend this chart out to, include the previous year or even year and a half, the line would be off the chart. Because what was the height we were at, DJ? Like 9?
You're up to 9.
Yeah, it's crazy to think about.
And I think as far as actual interest rates go today for mortgages, we hit the lowest point since, I want to say, February of 23.
Yeah.
So, we were at the highest point in October of 23. We're at the lowest point now since 23. So we're trending in the right direction to try and get that housing market stimulated.
Yeah. I'm going to jump over to the Fed watch. So this is kind of I don't know if you'd say it's 100% for sure. It's more like, hey, if we asked a bunch of economists what they thought the Fed was going to do, this is how it's kind of divvied up. So the expectation is 87% chance of a quarter cut in the Fed rate, with a relatively small 13% chance at 0.5%. I'd say I expect a quarter because I don't think they want to slam on the gas that hard.
Quarter's a lock.
Yeah.
At this point.
And then if we jump forward to November, looks like 50% chance of another quarter, maybe 50% chance of a full half cut there. Once again, I expect them to stay steady on this. I don't think they're going to do anything too crazy too fast. But what it means is you're going to see headline news that's good news. Buyers actually receptive to news that interest rates are improving. And I expect that to continue. I mean, if we keep skipping forward here to December, well, maybe another quarter cut. And then into January, maybe another quarter cut, beyond that. So it looks like we're trending in the direction of federal funds rate going down, which is going to make retail rates way more palatable as well.
And what you have to keep in mind when the Fed cuts these rates, i.e., a quarter, a half, whatever the number might be, the market has priced itself to the anticipation of said cut the previous couple of weeks. So right now, where rates are in the low to mid sixes, they're pricing in that that quarter percent cut already. What happens when the Fed cuts on September 18th, if they do cut a quarter percent, that means anybody that has a home equity line of credit, that interest rate's automatically going to drop a quarter percent within the next couple of days because that rate's all tied to prime. So every time there's a rate cut or a rate raise, prime lowers or raises accordingly. So anybody has a HELOC right now, home equity line of credit, you're going to be coming in some good times in the course of the next 12 months because your rate's definitely going to go down.
Yeah, I'm just looking forward to the anticipation or the more excited attitude out of buyers that the market might be improving for them. So,
right.
Which does kind of take us to where are rates today. And I know Hadley likes to default to this site. I do myself as well. I would say there's a bit of an asterisk with all of these numbers in that this is a national survey. Obviously, every lender has slightly different rates, but some of them are charging points to get these rates, call them, like teaser rates basically. And
these rates here, when you see rates like this usually assumes a 1 point cost.
Right. So I would say, it's probably not a full point for us to get to around 6.1%, depending on, if you're putting 20, 25% down with 780 credit. That being said, kind of a small asterisk with these. It's just a good indicator of where the market is currently. And you can see, obviously, we've been trending down here since, what was the peak there?
October.
The recent peak, April. So not too bad news for the spring and summer. With rates in mind as well, obviously this is not necessarily pertaining to buyers, but maybe recent customers or past clients. We obviously do refinances. It's certainly going to be a topic that's coming up. So if you or anybody or maybe your past clients as you're talking to them, if they're considering a refinance, very likely now's a good time. And if not now, then probably in the next 6 months to a year, it's going to be a no-brainer.
Yeah, on your side of the coin, Chris, we're talking about these rates right here. I said they come with a cost, usually a point. People may have heard me say over the last couple of months, I've put people into fives with a couple of points. And it makes a lot of sense because it takes away the need to refinance in the coming year. You've already got your house. You're going to have a nice low interest rate. You don't have to worry about spending costs again on a refinance. So we can do this today. You can get people in the mid to upper fives with a couple of points today, which to me makes a lot of sense versus taking a higher rate and waiting to refinance down the line for something that may or may not come. We have no control over what happens in next year here. All hell could break loose again like it did in 2020 and things go the other way.
Right. Yeah, you never know. And we were talking this morning about, okay, everyone likes to come out, or these big, institutions like to come out with where they think rates will be, next quarter and next year and so on and so forth. And it's funny because, they're never spot on. And often they're way off of where we actually end up. So, obviously we're making educated guesses sometimes when it comes to, hey, when's a refinance going to make sense for you?
Chris, that chart you're referring to, we talked about this morning, every one of those prognosticators, large banks, NAR, I forget who the mortgage bankers, I think everybody was saying rates between 6 and 6.25. And there might have been one that said 5 3/4. That's not far off from where we are now. That's what I'm saying.
Right.
A couple of points now to get the rate in the mid to upper fives.
Yeah. Speaking on paying a little points and just avoiding needing to do a refi down the road, literally right before we got on this call, I locked in a gentleman. He's buying an FHA duplex. He's going to do the house hacking method. We were weighing whether or not he wanted to pay points. Kind of the going rate on FHA right now, he's got fairly good credit, especially for FHA, is like 6.25%. 2 points will buy that all the way down to 5.125. And I was basically telling him, if you do that now, there's no refi in the future. I mean, you're taking care of the refi up front here because it's going to take a real long time to get down to 5.125. And just think, if you're talking about a refinance, you're going to need rates to get down to the mid fours for him to want to refinance again in the future. So go ahead and just take care of it up front.
You know, Chris, to value that buy down right there, that guy picked up over a full 1% for 2 points. The normal cost on a buy down in regular times, whatever those might be, is a point for each quarter in rate. So that guy picked up a full 1% or more for just 2 points.
Yeah.
So that is an absolute makes sense. And that's what we do when we talk to people. We look at the situation, points, no points, somewhere in the middle, to do with, to get them in the best possible position with the funds they have to work with.
Yeah, the big thing I think that sold him was the break even on that was just over 2 years. So I was like, you're going to have this for a while. You're probably going to feel good about it. I mean, that's why the banks are willing to do it, because he's going to probably hang on to that for a while,
Yeah, if he's house hacking.
Yeah. So, any questions there with rate, spread, markets, anything at all? Headline news?
Hi, this is Chris. I have a question. So I bought my house last year and I locked in, I think with you guys at like 6.1. What would you recommend as far as before refinancing, like a full point at least?
No, that's kind of an old wives' tale per se. Used to say, hey, when you can pick up 1%, that's a good time to refi. You always have to look at why you're refinancing. There might, we get in next year. I've been telling people the peak time to refi, I think, is going to be spring, summer of next year. And beyond that, who knows where rates are going to go to? So if you can pick up a half to 3/4, which you should be able to sometime next year, Chris, and maybe even a little bit more if you buy it down some, that's probably going to be the rate you have for the rest of the term there. And at that point in time, you may want to look at a 20-year term as well, or a 15-year term if it's affordable to you, because that rate will be even lower. And sometimes when you go from a 30 to a 20 at a lower rate, the payment doesn't move much.
Yeah. Oh, okay. I ran a scenario for someone that just bought 6 months ago. We're starting the refi discussion now. Flip to a 20. The rate is improving so much with the 20. He's paying an extra point to get it even lower. His payment's still going down $70 a month. His lifetime interest is cut more than half.
Wow.
So that's why you got to look at that big picture. You got to look at everything and not just go, I have to wait till it's 1%, because that may never happen.
Yeah.
Okay. All right. Thank you.
Yep. My rule of thumb lately has been, hey, when we get to that 0.5% in improvement, let's start the conversation. Let's quote a few numbers and get an idea of where you stand, and you can kind of decide if that's what you want to go for.
Thank you.
Yeah, for sure. Let's see. Adley gave me some notes here. He wanted me to mention reno loans. His own words, we do them, ... lots of them. So, for anyone out there that doesn't know, we do have a whole dedicated renovation department here at CCM, kind of alongside our construction to permanent department. We do a lot more, I would say, DJ, probably do a lot more reno than construction, wouldn't you say?
Yeah. And we do renovation loans on every product, conventional, FHA, VA. I believe we even have one for USDA. And we also do renovation loans for investment purchases. I think those are single family only, though.
Yeah. Yep. So if you got someone looking, the caveat I usually tell clients is the process takes a little bit longer, because you're going to need to have the renovations, the blueprints all figured out up front, because they're basing the value on the post renovation value. So we're going to have to know what kind of improvements are going to get made to the property to justify that higher value. So, always great to work with a trusted contractor that, is going to work in a timely fashion and get the job done. But, baking in maybe 45 to 60 days on a transaction like that is probably a little bit safer.
The other side of coin into the renovation product as well is, yes, the interest rate is higher than a going conforming product. But I can't tell you how many people I've done FHA 203K loans for And then 8 months later, I've refinanced them into a conventional loan with little PMI, maybe even no PMI, depending on the market, because of the improvements they've made to the house. So the rate you're going to have today on that renovation loan should not be the rate you're going to have in 8 to 12 months.
Yeah, I would totally agree. Anyone on the call ever done one of those before? It's a pretty easy process, to be honest. But
Paperwork laden.
yeah, that's the catch.
Those
maybe
deals will only go as well as the contractor completing the paperwork properly. All else is simple.
Yep. Yeah, and a little more on the buyer. Sometimes if we're starting that conversation, I usually say, okay, you might even want to start shopping for contractors now, before we even go into contract, just to get an idea. Do you trust this person? Did they give you a portfolio of their work? Do you feel good? Because once you're in contract, it's kind of go, go, go. And it would be really tough to switch contractors mid-transaction and close on time. So. Cool. You got any topics, DJ? Anything you wanted to bring up?
Yeah, I think I think some of the slides we listened to today from our CEO Ron Lenhart. We're heading close to a pretty balanced market as far as I think there's 4 months supply right now, 6 months considered balanced, and we've been trending towards that 6 months over the past year, albeit slowly, but we're getting to a pretty balanced market. I think things are looking pretty good.
Yeah, the wild number on that, or the date that I thought was crazy was 2019. It's not been considered a balanced inventory market since 2019. I mean,
Right.
Time flies, but that's half a decade ago.
Yeah.
So
So it's
wild.
almost, I think, what was there, almost 2 million homes on the market at that point in time, and right now I think we're at 1.4 through last month.
Yeah.
That's, of course, nationwide.
Right. It's interesting too, because some markets are already at or above that kind of inventory threshold that's preferred. Of course, Ohio not included in that. We're still below that ideal threshold, but there are other markets that have already gotten to that point, so
Right.
kind of trending in that direction.
It's funny, the other stat he put up was, if you saw it, remember it this morning, he showed different geographical areas of the United States, and kind of the Midwest is in that pattern where we're really not getting that growth of new homes coming on the market. We're kind of stagnant, believe it or not, which is surprising.
Yeah, I wonder how much new construction kind of limits us. If there's
right.
Cleveland's a really good example where it's like, well, you ran out of land to build. The only thing you can do is try and renovate, and the extra costs of taking on these big projects when you got to knock something down to build something new. People are like, I'll go to where the land is already empty. So
one more cool stat I'll throw out there, which to me was it was mind blowing to see that number. May not mean a whole lot to the realtors on this call here, but it'll tell you that there's buyers out there looking. The month of August, CrossCountry Mortgage had 51,000 credit pulls. That means 51,000 customers were out there looking for a pre-approval or a mortgage with us.
Yeah, just us, which is what's
51,000 credit pulls.
Yeah, there are certainly people in the market. I mean, a big chunk of those could be some people finally getting back into refinance shopping, which was a market that was all but dead for the previous 2 years.
Right.
That's finally coming back, but still, I mean, the vast majority of that is purchase, which is pretty cool. There are still people interested. Any questions in the crowd? This might be a quick call today.
One thing I do want to point out to everybody is I don't consider anybody in our branch, and I think there's 5 of us, Chris, are originators.
Yeah.
3 of those originators have 30 plus years in the business. I don't consider any one of us just rate quoters. When we get a phone call from one of your referrals, we're going to walk them through the process and kind of become financial analysts with them and use their money accordingly to the best of their ability to get them in the payment they want. And sometimes that means putting a little less down, paying off some debt, buying the rate down a little bit, and creating a lot more cash flow than they realize they could have possibly had coming out of rent going into a new mortgage. So just know that we analyze everybody to put them in the best possible position. It isn't just, hi, this is down, what's your rate? 5.25, click. That's not how we roll at our branch.
Right. Yeah, I would say for myself, I always say I'm less of a salesperson and more of an advisor. I'm just going, I'm going to do what's best for you and help. I had a funny call the other day. A guy called. He has a 3.5% interest rate that he got, back during the pandemic. He was calling about doing a cash out refinance. Didn't need much, just wanted like 25,000 to put a deck on his house, do some landscaping, something like that. And I told him, well, given your rate, you could do a cash out refinance, sure, but your new rate's going to look like this, your payment's going to look like this. What if I send you a link? Maybe look at the home equity line of credit we have. It's going to be faster, and the rate might be a little bit higher, but you won't have to refinance your entire loan. And I have a buddy in my fantasy football league. He works for Huntington. Other buddy, he's a realtor. I was telling them this story at the draft, and they were like, you're pretty nice for doing that. Most people, if he called an 800 number for, ABC Mortgage, some other state, they would have said, thanks, apply here. And they would have, never even talked about how we might be giving up that rate. And I was like, I guess sometimes you got to choose the good guy path, which was, giving that guy good advice, I suppose.
And that HELOC Express that we have,
it's
kind of a 5-minute application, upload your documents, 5-minute approval, and you can close in about 5 to 7 days and have your money on that thing. When it comes to products, CrossCountry Mortgage has, I say there's only one product that we really don't have, and I say it's a lot loan. We can do lot loans, but we have to broker them out. But when you broker that out, you lose all control and you get yourself in a lot of trouble. I have enough people in this industry that work at banks and other companies that can do lot loans that I refer those to. But just know that we have every single product available that you need, from conforming to non-conforming, jumbo. Again, the only thing we don't really do is a vacant land lot loan.
Yeah. Good stuff.
Yeah. And we're trending in the right direction, man. Rates are starting to head down and level off, and that's a good thing for everybody involved. Hopefully get some excitement with the rate drop in the upcoming week here, and get the buyers back out there, get some people interested in selling homes. And if your customers are asking, can we get rates in the 5s? Yes, you can. There's a little bit of a cost. And I'm one of those guys this branch has been in this business for over 30 years, and it was normal back then to charge people points. So you did it to buy the rate down, and don't be afraid for that to happen today.
Yeah, I always quote it both ways. I'm like, here's no points, here's with points, monthly, break even return on investment, and then just let them decide which direction they want to go.
People beat us up over an 1/8 in rate or 0.05 in rate, but they're more than happy to open up a credit card at 26 or 27%. Blows my mind.
That and auto loans these days. I can't believe that, what's the average car payment these days? Like $700-800.
It's insane.
Yeah.
And then car insurance going up, that was a part of our CPI staying where it was at instead of dropping a little bit further as car insurance is up. So good stuff. And like I said, you guys all know where to find us. We're all in the office somewhere. I'm on the west side. Chris is covering Sean's office, and he's down in Solon as well. And you guys know where to find Hadley every day.
Yep. Any questions before we close it up?
Good deal.
All right. I appreciate it. We'll see you again at the next one. And
appreciate your time, guys.
If anything comes to mind, just let us know.
Hey, see you at the Clam Bake next week.
Oh yeah, there we go.
Thanks.
See you guys.